Quit staring at spot price. Ignore the charts. The narrative we've hyped about this rigged market for 15 years just totally imploded today. For 10 years, we thought we battled the bullion banks. We swore they were trapped in huge naked shorts tamping price to live. When silver mooned, smashing resistance levels nobody saw coming, we reckoned we'd finally won. We figured this pump was their total defeat. It really wasn't. This wasn't a short squeeze, it was a full reveal. The most dangerous moment in a market isn't a crash. It is discovering the narrative guiding your decisions was wrong, because fresh data just rewrote the entire history of physical silver. JP Morgan wasn't trapped by this moonshot. They didn't panic. They held the reins. They were prepped. While stackers raged about rigging and paper shorts, JPM was executing a play that was far more strategic. They were actively stacking physical silver. Quietly, methodically, for many years. Not paper, not promises, real, shiny metal. And now the scale of that accumulation is fully visible. Approximately 750 million ounces of real physical silver. That number changes the whole game. It means the largest bank in the system is no longer incentivized to suppress price. It means the entity we thought was the enemy is now positioned to benefit from higher prices. Ask yourself one question. If you held that much of a scarce, irreplaceable asset, would you fight the moonshot, or would you unleash it? Exactly right. This is the moment the old lore dies. Because the bank we thought we were fighting isn't in our way anymore. It is moving in the exact same direction, but for very different reasons. And when the most powerful bank in the world decides a real asset will be repriced, the market does not argue. It simply follows along. To see how this trap was built, and why the next phase will be far more dangerous than anything we have seen before, we have to go all the way back to the start. Right back to the crime scene. If this changed how you see the rigging, subscribe and comment 1 if you are ready to continue on. To understand this bear trap, you have to go back to 2008. Not the headlines, not the panic, the balance sheets. When the system cracked, one bank fell first. Most recall it as a victim of bad mortgages. What almost no one talks about is what sat on its books, a massive concentrated short position in silver. Hundreds of millions of ounces sold on paper, way beyond physical reality. That short wasn't an accident. It was a control tool. For years it capped pumps, crushed momentum, and kept silver cheap, dull, and ignored. But in early 2008, silver mooned anyway. Margin calls followed. Liquidity evaporated. The weapon turned inward. When the rescue was forced, the acquiring bank inherited that short position. The market assumed it would be closed immediately. That assumption was simply fatal. Because the short was never closed. It was surely kept. Owning the dominant short position doesn't just manage risk, it governs price. It lets you decide when pumps fail and when fear returns. And every time price was smashed lower with paper, something really critical happened behind the scenes. Physical shiny metal moved. Miners sold cheap. Weak hands panicked. Supply appeared briefly and disappeared just as fast. The same entity driving price down was waiting underneath, absorbing all the real metal, ounce by ounce. Paper pressure funded real physical ownership. This cycle repeated for years. Rallies died. Confidence eroded. Silver became boring. And while the public focused on charts and outrage, real vaults quietly filled. By the time most people sensed something was wrong, the market had already been fully drained. That's the real original sin of this story. The short was never the problem. It was the tool. And once you see that the next phase becomes inevitable because no one builds that much control without a final move. And that move was surely coming. Once you understand that the short position was a tool, the next phase becomes obvious. Control was never the destination. Total ownership was. For years, the market thought silver was dead. No momentum, no excitement. Every rally failed. Every breakout collapsed. Analysts dismissed it as a relic, a useless metal in a digital world. That boredom was not accidental, it was engineered. Because boring markets are easy to drain dry. Each time price was pushed lower, confidence broke a little more. Retail investors walked away. Institutions lost interest. Mining companies starved of capital sold production at whatever price they could get just to survive. And in that environment, real physical silver became available, but only briefly. Every dip created supply. Every single dip was met by the same buyer. This wasn't impulsive buying, it was industrial-scale accumulation. Vault capacity expanded quietly. Custodial roles grew. Inventory moved out of visible circulation and into private hands. The metal didn't disappear overnight. It vanished slowly enough that no alarm bells ever went off. That was the pure brilliance of the strategy. Instead of chasing price higher, they forced price lower. Instead of competing with demand, they created despair. And despair is the cheapest source of supply in any big market. Year after year, the pattern held. The public saw manipulation. What they didn't see was conversion paper pressure being transformed into physical ownership. Losses on one side were offset by assets on the other. What looked like suppression was actually pure harvesting. By the time industrial demand began accelerating, solar electronics electrification, the easy metal was already gone. The float had been shrinking, while no one was even counting. This is why the market feels different now. Because accumulation phases don't announce themselves, they end suddenly. And when they end, the behavior of price changes forever. The moment accumulation stops, price suppression becomes impossible. When the whale controlling the paper ceiling steps aside, the silver market does not drift higher. It snaps. That violent snap is exactly what you are witnessing now, and it signals a move far riskier than a rally. It signals the whale is done stacking ounces and is ready to let the spot price do the work. Stacking physical always ends the same way, quietly, then it goes all at once. For years, the rigging holding silver spot down was constant. Every rally met tamping. Every breakout was capped. The ceiling stayed put until suddenly it moved. That was not an accident at all. It was a firm decision. Sometime in late 2025, the operator left the COMEX control room. The paper pressure that defined the market for a decade was lifted. The bank that once spent billions suppressing spot price no longer had a reason to do so, because the physical accumulation was fully complete. Once you stack enough of the physical metal, the incentive structure flips. Spot price is no longer something to fear. It becomes the weapon, and the moment that shift happens, market behavior changes instantly. That is why silver spot did not grind higher. It launched hard. There was no prolonged battle at old paper resistance. No extended consolidation. Price moved vertically because the dominant short seller vanished. The brake pedal was released and gravity took over in reverse. This is where most paper traders get confused. They look for a catalyst or news. They assume a short squeeze, but this was not panic buying. It was pure absence. The paper ceiling was not broken. It was removed. Every fiat dollar higher now benefits the largest stacker in the market. Every pullback becomes optional. There is no longer a structural force committed to tamping spot down. Volatility may remain, but the direction has changed. And that market change is permanent. Markets do not forget who controls the real supply. Once spot starts moving in an environment where the float is thin and the largest stacker is aligned with higher prices, the path of least resistance points one way. Straight up. This is why the old paper playbook stopped working. This is why selling pressure looks weak. This is why dips feel shallow and temporary. The regime has shifted from suppression to true repricing. But the switch was not flipped blindly. It was well timed. Because no one releases control without a reason. And the reason for this move was not paper speculation. It was necessity. Something bigger was coming, something the market could not ignore. And to understand why the timing mattered, you have to look beyond spot price and into supply itself. That is where the real physical leverage begins. Spot price can be argued. Supply cannot. Silver is not scarce because of sentiment. It is scarce because geology sets limits that paper finance cannot override. Every year, the entire planet produces a finite amount of silver, and most of it is not mined on purpose. It is a byproduct pulled from the ground while chasing other metals. That makes supply slow, rigid, and brutally unforgiving. Real demand, meanwhile, does not wait. Electrification, solar panels, electronics, medical equipment, defense systems. Silver sits at the center of modern civilization. Unlike investment demand, industrial demand does not care about spot price. It cares about continuity. Factories do not shut down because silver gets expensive. They shut down when silver is not available at any price. That distinction changes absolutely everything. For years, paper markets created the illusion of abundance. Futures contracts multiplied supply that did not exist. Spot prices stayed low and industries built their cost models on that fiction. Just-in-time delivery replaced stockpiles. Inventory became a liability. Efficiency became doctrine. And now that paper illusion is cracking. When physical availability tightens, spot price does not adjust smoothly. It gaps. Because the buyers stepping in are not traders chasing upside. They are procurement managers with contracts, penalties, and production lines on the line. They buy because failure is not an option and delays are not acceptable. This is where control over physical inventory becomes power. When supply is thin and demand is mandatory, the holder of physical metal dictates terms not by force but by restraint, by choosing when to sell, how many ounces to sell, or whether to sell at all. That is the reality the silver market is waking up to, and once necessity enters the equation, price targets stop being opinions. They become hard requirements. When physical supply tightens, markets instinctively search for relief. They look for a stabilizer, someone willing to release inventory, absorb volatility, and restore order. In oil, that role belongs to nations. In agriculture, it belongs to governments. In silver, there is only one holder large enough to matter. And that fact changes the entire stacking game. When a single entity controls a disproportionate share of available supply, it becomes the buyer of last resort on the way down and the seller of last resort on the way up. That power does not need coordination announcements or headlines. It operates quietly through patience and total absence. If spot price dips, there is no obligation to sell. If price rises, there is no urgency to act. Time becomes an ally, not a risk. Every day the structural deficit persists, the leverage embedded in physical inventory increases. This is why volatility no longer signals weakness. Pullbacks do not mean distribution, they signal discipline. The absence of forced selling is the tell. No panic, no desperation, just pure controlled restraint. Markets are conditioned to expect central banks to intervene when stress appears. This is the opposite dynamic. This is a private holder allowing pressure to build because pressure increases value. The more strain placed on the system, the more essential each troy ounce becomes. And here is the decisive shift when industrial users enter the market, selling stops being optional. It becomes survival-driven. Buyers do not negotiate prices, they accept them. True price discovery accelerates not from speculation, but from the fear of interruption. That is how repricing happens in the real world, not through headlines, but through urgent purchase orders and empty factory inventories. And once that process begins, it does not ever reverse. Because relief can only come from supply, and real supply is controlled. No market is ever cornered by accident. It happens when pressure arrives from more than one direction at the same time, slowly, quietly, and then it is all at once. First, physical supply tightens up almost invisibly. Export flows dry up. Refining capacity shrinks down. Logistics turn political. Then real inventory moves into stronger diamond hands. Each force alone is painful. Together, they destroy every single paper-silver escape route. This is the ultimate squeeze. When external flow halts while physical stockpiles are deliberately withheld, buyers lose all optionality. They cannot source bars abroad, and they cannot coax them out domestically. Spot price no longer balances supply and demand rationally. It becomes a huge premium payable only by those who stacked early or can afford desperation. In this rigged market, timing matters far more than intention. Whoever moves first doesn't win. The prepared stacker does. In silver, preparation means possession, not paper contracts, not promises, physical metal. The genius of a squeeze strategy isn't aggression. It is pure patience. One side applies pressure by restricting flow. The other applies pressure by refusing relief. The squeeze doesn't require constant force. It tightens automatically as COMEX inventories drain and delivery deadlines approach. That's why the move feels sudden. The scam absorbs stress quietly until it can't. Then behavior changes overnight. Orders stack up, premiums detach from spot prices, availability disappears without any warning. This is the phase where price stops reflecting value and starts reflecting urgency, where hesitation becomes major risk, where procurement becomes total panic. And in that moment, every remaining physical ounce becomes leverage. Because in a silver squeeze, survival doesn't belong to the loudest buyer or the fastest trader. It belongs to the smart money holding the physical metal. Every corner creates winners and victims, and the most common mistake investors make is assuming the victims are just small players. They definitely aren't. The true victims of this squeeze are the largest, most powerful industrial consumers in the world, the tech companies that built trillion-dollar empires on the assumption that raw materials would always be cheap, abundant, and available on demand. For decades, technology and manufacturing were subsidized by artificially low commodity prices. Hardware was treated as disposable. Supply chains were optimized for efficiency, not resilience. Inventory was eliminated. Price risk was outsourced to the market. That system worked only because someone else absorbed the price pressure. Now that pressure has nowhere left to go. When silver availability tightens, these companies don't have flexibility. They don't hedge years in advance. They don't stockpile critical inputs. They rely on just-in-time delivery to keep margins high and their balance sheets clean. That lean model collapses instantly when supply stops moving. Production schedules don't care about narratives. Contracts don't care about ideology. A factory without silver doesn't slow down, it just stops. And when it stops, the losses compound by the hour. This is why the coming demand won't be polite. It won't be gradual. It will be urgent, forced, and price insensitive. Procurement managers won't be negotiating spot discounts. They'll be securing survival. And here's the cruel irony. The very system that suppressed prices for years encouraged this vulnerability. Cheap paper silver taught industry to be careless. Stability bred dependency. Now that stability is totally gone. This is where the transfer begins, not from retail to institutions, but from industry to inventory holders. From balance sheets built on efficiency to private vaults built on possession. The winners won't be the loudest voices in the rigged market. They'll be the ones who stacked silver when preparation looked unnecessary. At this point, most people think the story is finished. Supply is tight. Inventory is concentrated. Industry is trapped. End of deep analysis. That blind assumption misses the most important layer of all. Because silver isn't just an industrial metal. It's a monetary mirror. And what it's reflecting now isn't just scarcity, it's fiat currency stress. When a critical commodity reprices sharply, it forces a question. No central bank once asked, what is the unit of account actually worth? Rising silver doesn't just signal demand, it exposes dilution. It reveals how much paper has been created relative to real things that cannot be printed. This is where the trade stops being about metal and starts being about real money. As prices rise, policymakers face a dilemma. Tight supply drives inflation, signals higher. Inflation pressures interest rates. Higher rates threaten debt markets, and when debt markets wobble, intervention follows. Liquidity returns, balance sheets expand. The fiat currency absorbs the shock. Silver responds to it immediately. This creates a feedback loop that is hard to interrupt. Scarcity pushes price up. Price signals inflation. Inflation triggers easing. Easing weakens currency. A weaker currency pushes silver much higher again. This is not speculation, it's basic arithmetic. And the holders of physical metal understand this better than anyone. They aren't just holding inventory, they're holding insurance against the very system pricing that inventory. Every single ounce represents optionality outside the currency framework. That's why selling becomes less attractive as price rises. You're not just giving up upside, you're trading something finite for something infinitely expandable. This is the hidden force underneath the entire move. Supply pressure lights the match. Monetary response pours fresh fuel on it. And once that cycle begins, it doesn't end with a neat top or a tidy market correction. It ends only when confidence breaks. And that brings us to the final chapter, because knowing the structure is useless unless you know how to safely navigate it. This is where everything now converges. What began as a story about suppression became a story about accumulation. What looked like manipulation revealed itself as preparation, and what now appears to be a price rally is in reality a structural reset driven by scarcity necessity and total monetary decay. The lesson is simple, but uncomfortable markets don't reward outrage, they reward early positioning. For years, silver holders were mocked for owning something boring, volatile, suppressed, but boredom was the price of admission. It was the tax paid to stay positioned while the real game unfolded quietly in the dark background. Now the game has finally changed. When supply is tight, inventory is concentrated, industry is trapped, and fiat is weakening price. No longer reflects opinion. It reflects leverage, and leverage belongs to whoever holds the real metal others must have. That is the ultimate squeeze. This doesn't mean there won't be volatility. There will be. Sharp pullbacks, paper market smashes, attempts to shake confidence. That's how powerful players extract remaining supply. The mistake is confusing noise with direction. The direction is set by the math, not by emotion. So the strategy isn't chasing tops or timing perfection. It's understanding what you own and why it matters. You don't sell